In this video, you are going to learn accounts receivable. Chapters I have discussed are: what are accounts receivable? Example of accounts receivable. What is the accounts receivable turnover ratio? Benefits of accounts receivable, and disadvantages of accounts receivable. Let's start the video. The word receivable refers to the payment not being completed. This means the company must have extended a credit line to its customers. Most businesses sell to their customers on credit. That is, they deliver the goods and services immediately, send an invoice, then get paid a few weeks later. Businesses keep track of all the money their customers owe them, using an account in their books called accounts receivable. The total amount of accounts receivable allowed to an individual customer is typically limited by a credit limit, which is set by the seller's credit department, based on the finances of the buyer and its past payment history with the seller. You can locate accounts receivable under the current assets section on your balance sheet. Accounts receivable are classified as an asset because they provide value to your company. An example of accounts receivable includes an electric company that bills its clients after the clients received the electricity. The electric company records an account receivable for unpaid invoices, as it waits for its customers to pay their bills. Now come to, what is the accounts receivable turnover ratio? The accounts receivable turnover ratio shows you how fast your customers are at paying their bills. We calculate it by dividing total net sales by average accounts receivable. Let's use an imaginary company XYZ Incorporated's financials for the year 2020 as an example. Let's say that on the 1st January of 2020, XYZ Incorporated had total accounts receivable of $2,500. Let's also say that at the end of 2020, i.e. December 31st, its total accounts receivable was $1,500. It also had total net sales of $60,000 for 2020. To get the average accounts receivable for XYZ Incorporated for that year, we add the beginning and ending accounts receivable amounts and divide them by 2. To calculate the accounts receivable turnover ratio, we then divide net sales, that is $60,000, by average accounts receivable $2,000. This means XYZ Incorporated has an accounts receivable turnover ratio of 30. The higher this ratio is, the faster your customers are paying you. 30 is a really good accounts receivable turnover ratio. Benefits of accounts receivable. Allowing more credit to customers can expand the number of potential customers for a business, resulting in an increased market share. But if some of them are paying you late, or aren't paying at all, selling to them could hurt your business. Late payments from customers are one of the top reasons why companies get into cash flow problems. One of the best ways to keep track of late payments, and make sure they aren't getting out of hand, is to calculate the accounts receivable turnover ratio for your business. Now move on to disadvantages of accounts receivable. There are several risks associated with carrying a large accounts receivable balance, including uncollected debt. High accounts receivable that goes uncollected for a long time is written off as bad debt. This condition occurs when customers who purchase on credit go bankrupt or do not pay the invoice. Cash flow deficiencies. A business needs cash flow for its operations. Selling on credit may increase revenue and income, but it offers no actual cash inflow. In the short term, it is acceptable, but in the long term, it can cause the company to run short on cash, and have to take on other liabilities to fund operations. If you want to read in details and download the PDF, go through the link in the description. If you find the video helpful, give us a like, share the video, and don't forget to subscribe to Education Leaves.